I'm Chris Preston.
And I'm Brad Simmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been in business for more than half a century, delivering investment advice to individual investors. Um, Brad, did you watch the most hyped slash the least bang for buck event I think I've ever seen in my life? Tyson versus Jake Paul. We've talked a lot about 90s nostalgia, like in movies and documentaries and things that have come. I think this might have been pushing it too far, having a 58-year-old out there trying to box a
I
26.
so I have to give credit where it's due first. Taylor Serrano, the
That
fight
fight was
before
good.
that,
That
that was
fight
a
was really good.
phenomenal fight.
Yeah.
They came out swinging like heavyweights. I always like heavyweights more because there's always like the puncher's chance of turning the fortunes around versus, the middleweight or lightweight guys where you're just mostly winning on points. And it's like once you have 9 rounds in the bag, it's over. Uh, One of my brothers and I were texting. One of them texted that it just looked like Jake Paul was bullying an old man, which is how it felt. It was not
But not even
not a
in an
fun.
impressive way. He didn't dominate him. Maybe he was taking it easy on him. I have no idea. But it was Mike Tyson wouldn't throw a punch
Yeah, it felt
after the first round. He like had one round in him and then he just didn't throw a
now.
punch. You're just biting on his gloves the whole time.
Yeah, the online theory is that he was biting his gloves to remind him not to swing because the fight was fixed. That's like the conspiracy theory, and it certainly looked that way. I don't know. I mean, the guy had a heart attack in June, right? Like there are other elements that are
Yeah.
beyond just showmanship or whatever, but it was not a great fight. The two of the undercards were good.
Yeah, the two fights
I,
before it were really good.
First
Especially
fight was a joke.
I
Uh,
missed the
it
first
was
fight.
some influencer with like two professional fights going up against a guy from India that had wanted to fight Paul, but Paul wouldn't fight him. So he's like, "Oh, well, you can fight this other influencer guy," and he did not train for it. He didn't take it seriously. It was a bad fight.
Okay.
Did you
But
have streaming problems with
yeah, I think
Netflix?
everyone did.
Yeah.
Ours were pretty, so I was in Montreal. So I was not in this country for up there for my wife's birthday with some friends. And yeah, we kept thinking it was, a Canadian problem, but it was relieving to hear that it was across the board. Ours weren't terrible. It weren't, at least it wasn't at the wrong times. It was not during the fight so much.
Yeah, I kept losing it. I don't know. Like 60 million people tuned in. I don't think that many people are going to tune in for football and Christmas, but
No.
it doesn't set the stage for uh, you know, dominating
Yeah.
success. Netflix stock 900 a share though.
Yeah.
I
I
think
mean, 60 million is the key. 60 million households is the key word there. That's all that Netflix cares about. Yeah, maybe not the best first impression in terms of their live sports. Yeah, they're going to have football on Christmas Day, I think two games. Um, but, if they'll get eyeballs, for sure.
so. Earlier this year, you and I did a like a bracket to pick our favorite stock for the rest of the year.
Yep.
And I believe that we'll find this out when we do hot sauce stuff later, but
Yep.
I believe our consensus was Netflix. We have
I believe that's right.
92% this year.
That's why people should listen to this podcast.
Yeah. Yeah, we're right about stuff.
We're right about
We
stuff.
joke that we're not, but there's plenty of times that we are.
I know. I think it's not just the Fed that we're usually right about. Okay. Well, speaking of, we'll get into other things. And now that we've said that, I'm sure we'll get everything we say today wrong. But tell people what we're going to talk about today.
First, we are going to talk about Target missing earnings and taking a little bit of a tumble afterwards. MicroStrategy faced a short tweet from Citron Research, a pretty well-known short seller. And then we'll talk about Spirit Airlines going into bankruptcy after after the close on Friday, so over the weekend, and then that initiated trading. After that, we're going to have Nancy Zambell on of Cabot Money Club, and we're going to talk all about bull market, housing, all those wonderful things. Uh, Before that, though, Chris, it is your time to defend the take this week. Nvidia is no longer dominating the market, and that is a good thing. You have 90 seconds, and you may begin.
Yeah, I think the collective sort of shrug of the shoulders after this week's Nvidia earnings report. There wasn't felt going in, there wasn't the same anticipation as there was for the past several Nvidia earnings reports. It wasn't the sense of everything rides on this. Now, maybe that's partly because there's been other even bigger events recently with the election, Fed rate cutting, all the stuff going on overseas, geopolitical stuff happening. But it, the stock didn't. It was perfectly good earnings report, but more than good. It was what, 90%, I think, earnings growth, which, shy of what they've been recently. But still really good, still better than expected. But now people just expect Nvidia to, they've set the bar so high that they're in the zone that Apple was, say, 10 years ago, or maybe Tesla 5 years ago, where just everyone just expects them to blow estimates out of the water. But the fact that they didn't, stock didn't implode, about even since earnings, and so is the market. And that's a good place to be. Nvidia we've talked about the Mag 7 having way too much influence on the the market this year, and Nvidia specifically. And it seems like we're starting to get untethered from that a bit. And that's a good thing because we can't have the market depend on one stock.
Yeah, time. Yeah. Yeah, it's good to see. It's certainly healthier if like obviously the market cap weight is still there. If
Yep.
Nvidia craters, it's still going to have a disproportionate impact on major indices and stuff. But yeah, I think solid quarter, beat no raise. It's sort of the cadence that they've been on for the last few quarters.
Yeah.
I don't know. Still waiting for signs of profitability from all these AI companies, but
Right. Maybe that's the key. That's why there might have been a collective yawn, that that's just not there. And I think just we've talked about how the AI sort of fever has cooled off lately, and maybe this is just a byproduct, or maybe I don't know if it's cart before horse or horse before cart. I don't know, but Nvidia, the anticipation was not as high for Nvidia, or anticipation slash angst over Nvidia's earnings, as it has been in recent quarters. I didn't think.
yeah, I think Jacob Mintz had written that the options market was pricing in like maybe as much as a 4 to 6% move, and it's up 2.5% in the last week. It really was not move. Really did not move much on the earnings report itself at all. But like that's what you would expect from a $3 trillion company. It takes a lot of money to throw shares around. So certainly feels healthier. I mean, like as
Yeah.
much as we like to prognosticate, not having to try and predict the future with some of these mega cap tech companies is certainly makes the job easier.
Yeah. Um, yeah, I think, I think what we sat here 6 months ago or something and said, it might have been your take, said, this is Nvidia's market. We're just all living in it. And that's no longer, it's it's still the case to a degree, but it's not the dominant force that it was, as recently as 6 months ago. And just to clean it up a bit, revenue was up 94%. I think I said earnings. Revenue up 94%.
Yeah,
Um,
they guided,
Earnings 102%. So even
and I
better.
think they guided for like 70% growth rate next quarter, something like that. Just because of the cyclicality, because right now everybody wants Blackwell, everybody wants the chips, but once everybody can get them, there is still cyclicality built into semis. I do think that ultimately it comes down to how much are other big tech companies willing to keep spending.
Yeah.
Until they stop, there's not anything that's going to stand in Nvidia's way. And unless you're on the board of Microsoft or something like that, it's a guessing game.
Yeah. It's still no knock on Nvidia that it's not dominating the market. It's still a great investment. But it's not the sun around which everything orbits as much as it was at least 6 months ago. Um, did I have that right? Yeah. Anyway.
Yeah.
All
Yeah,
right,
it's
moving on.
heliocentric. We
Yes.
learned that 500 years ago,
Yeah.
400 years ago.
Yeah. Moving on to the big three. Other end of the spectrum from Nvdia, Target. Um, they did not have a good quarter. Their earnings fell well short of estimates. Stock was down, what, 22%, as much as 22% right after, which is not something you see from Target very often. We've seen an increasing amount of, we talked about this last week. This is our featured segment like last week. The increasing number of earnings, extreme earnings reactions in either direction,
Yeah.
either huge bump or a big blow up. Target wouldn't have been towards the top of my list in terms of having that kind of a reaction. What does their disappointing quarter and subsequent blow up, what do you think that portends for retail as a whole as we head into Black Friday? Earnings season is just about, it's basically over at this point, but as we head into, Black Friday next week, holiday shopping season, do you think that's a bad omen or um, sort of a one-off?
So first, just a little bit of context on Target's earnings. 85 earnings per share in the third quarter versus 210 a year ago. Expectations were 230. Their third quarter income was down 11.2% to 1.2 billion, but their digital sales were up 10%. The issue that they seem to be facing is their margins were a little bit weaker, down 0.6%. They blamed the port strike and supply chain issues as causing them to sort of front load orders and, have availability concerns. But Jeffries said they just misjudged demand and pricing. And that's on the heels of their announcement to slash prices on like 5 to 10,000 items over the summer. When everybody was clamoring for lower prices, and I think they continue to. There is an element to it, I think, certainly of, hey, people, the stuff you buy at Target, you now buy online, you now buy through Amazon. If you are budget conscious, you buy it at Walmart. I do think that it's going to be it's somewhat reflective of what we are seeing more broadly, which is sort of hollowing out the middle class,
Yeah.
right? Like the discount retailers, your Walmarts, probably not your dollar store stocks. I think those the dollar store companies have struggled just because the companies are run poorly. But certainly discount retailers like your Walmarts are picking up more traffic. Um, you've got like the upper echelon of spenders that are not yet downgrading to Target. Stock market's at all-time highs, right? They are feeling wealthy, but that middle of the road, that sort of middle class is feeling the pinch a little bit. And I
Yep.
think that's going to be tough for a lot of consumer discretionary stocks that are sort of in that category. Like maybe Chanel does fine for the next 6 months, but like Nike takes a hit, or somebody else that's sort of appealing more to the suburban middle class. That would be my concern, or my takeaway from it is that like maybe there's some more weakness in the middle.
Yeah. I mean, yeah, it was the same theme that we've been hearing about for months prior to the election. Get back to the middle class. That seems like that applies to, like you said, stores like Target, sort of the aimed at the middle class. I wrote about Black Friday, so did a primer for Black Friday today, actually. And I looked at sort of consumer sentiment measures, and it's still low. Even though the economy has made strides, they're still seeing that people don't feel it like it's made enough strides, and this people are still probably feeling the effects of high inflation. Middle class might not be feeling the same way as like you said, the suburban, upper middle or upper class types. But yeah, looking at the consumer sentiment, it was still lower than it was. It's still lower than it was at any point prior to COVID. And then also during 2020, 2021, when we, had all the stimulus money and sentiment was way up. Um, I think we're just going to see another sort of mixed Black Friday and holiday shopping season growth, but similar to, you know, retail sales as a whole have been trending, which is, 0.4% in October, up 0.8% in September. Not horrible, but it's growth, but yeah, and those are month over month figures, by the way. But it's not, anything jaw dropping. The best month was July, 1.2% month over month. I think we'll see a fine holiday shopping season, but nothing spectacular. And that I think there'll be some Target, some companies like Target that, fall well short of expectations, and there'll be some others that do really well. I mean, we just saw that consumer discretionaries in this quarter it's 9.1% growth on average, which was higher than the 5% growth among S&P companies. Consumer staples only 2.4% growth. It's, sort of mixed there. I don't know that this Target miss is like a harbinger of, all retailers having a bad holiday shopping season. I don't think that.
No, yeah, I agree. I actually there are a couple of names that I sort of like going into the end of the year and then into like the first quarter of next year. Um, we are we are seeing certainly in headlines, and we'll probably see in actual figures when they start coming out, next year. We are seeing a little bit of a push to do any kind of planned spending on big ticket items before the potential impacts of tariffs would be felt. So if you are looking at retailers that generate a lot of revenue from larger ticket items, especially something that's heavily imported, or that it is likely to feel the price hikes from tariffs, somebody like a Best Buy, maybe a Home Depot or Lowe's, right, where you've got
Yeah. I highlighted
big
Home Depot in my article, actually. Yeah.
so somebody like that where it's like, hey, you're going to spend $1,100 on a washing machine or 800 or $900 on a TV or whatever, and that's going to be, $1,200 in 3 months or 6 months if tariffs come down sort of as expected. I do think that there's enough room in the budget for a lot of households to just accelerate that purchase a little bit and get it done now. So I wouldn't be surprised with some really positive fourth quarters from some of these more specialized retailers, especially those that have big ticket multi-part items. Like I don't think you're not going to go to Home Depot and like buy a bunch of lumber because you've got a construction project that's planned. You can't really do that effectively as an individual. But if you're considering something like a washer dryer that's going to be assembled with parts made globally, and probably built in Mexico or elsewhere, that kind of item, I think, gives you an opportunity to maybe outperform for fourth quarter earnings. It won't be reflected in the third quarter for any of these names. But if the economy is still doing well and you want to try and make like a short-term play, I think Q4 earnings for some of these other names will actually have some opportunity to surprise to the upside.
Let's move on to our next item, MicroStrategy, MSTR ticker symbol. It's a cloud-based, a large cap cloud-based business intelligence company that has been performing very well this year, up 523% year to date. But they were just hit with not a short report, short tweet, I think, as you cited, by Citron. I'll let you cook on this one and talk about the accusations and sort of the ramifications.
All right. So this one is a weird one to me. I was complaining about this to Jacob because it sort of the timing on it doesn't make a ton of sense to me. MicroStrategy is ostensibly a software company, but they're basically a Bitcoin holding company at this point. Michael Saylor's high profile crypto advocate, and what they do is they sell equity, they sell debt at low rates and use it to buy Bitcoin and basically just build up a Bitcoin treasury. The tweet was from Citron Research, which is a pretty well respected short
Yeah.
firm. They were a bigger name, I don't know, 10 years ago. These days, Hindenburg is probably the better known short firm. But Citron basically just tweeted, yeah, even Michael Saylor's got to think that MicroStrategy is overpriced at these levels. And MicroStrategy dropped 20% as of right now from the open on November 21st, so yesterday, but they're still up 24% on the week. The core attack, if you want to call it that, is MicroStrategy is worth about 4 times more than its Bitcoin holdings are. So they are massively inflated relative to the value of the only thing people are buying it for, which is their Bitcoin exposure. The thing that catches me off guard is like, this is well known. Anybody that's buying MicroStrategy should know that they're paying 4 times what the actual Bitcoin is worth. I don't understand where the reaction comes from. I honestly do not understand who's caught off guard or who's reading this tweet and saying, "Oh wait, this is not what I thought what I was buying." We wrote about Bitcoin in the daily 2 weeks ago and said the not that it was overvalued specifically, but that it was highly leveraged, that it represents more than 4 times the value of its Bitcoin holdings. This shouldn't have caught anybody off guard, and there's really no reason that a single tweet from Citron should have caused all these people to rethink their core investment thesis or their ideas.
Yeah, and it seems like this is a one-day phenomenon. People who did think that it was a classic one-day market overreaction with the stock down, what, 9, 10%, 10%. Now it's bouncing back, and that's in a month in which the stock is up 95%, 94 or 95%. So in the grand scheme, it's not really much of a pullback. It's not much panic. We'll see what happens from here, but it's bouncing back today. And I I don't know. I think we the same way we've talked about how Bitcoin is a bull market play and has been thriving. It's now up to what? Over 100, or sorry, over 100,000. Is that right?
It's
Um,
knocking on the door.
Knocking
It's
on the door.
broken 99, so I think now it's in the 98s, but it's
Yeah.
knocking on the door of 100,000.
And
Um,
this is like, Bitcoin on steroids, and like you said, 4 times the value of Bitcoin. So I think as long as the bull market remains intact, this will probably do just fine, regardless of what Citron says.
Here's my public service announcement. If you want leveraged exposure to Bitcoin, don't buy MicroStrategy. Buy
Yeah.
options on IBIT. Those just started trading this week through a lot of brokerage firms. They just got approved big options on the Bitcoin ETFs. If you want leveraged exposure, just buy leveraged exposure and don't rely on the performance of an unrelated third party who has a seemingly magic Bitcoin machine and is going to be really subject to the whims of the market.
Yeah.
Um, it boggles my mind that it's this overvalued, but it also boggles my mind that a single tweet was enough to take 20% off the price of shares for information that ostensibly everybody had access to.
Yeah. Okay, let's move on to our last one. Again, other end of the spectrum, Spirit Airlines has filed for bankruptcy, is filing for bankruptcy. Um, seems like another case of haves and have-nots. The airlines have had a banner year. United Airlines just keeps going to new highs. I know American Airlines, Delta Airlines, the big boys have had a really good year as travel has returned to, higher than 2019 pre-COVID levels. Spirit, I rode Spirit last April break this year down to Florida. It doesn't surprise me. I'll let you get into the details, but just anecdotally, Spirit kind of sucks.
I
It's discount, that's great, but you come out feeling worse because they nickel and dime you for everything else. For check a bag, oh, that's $50. Um, get a snack on board, that's another $25. Anyway, I'll let you talk about it more on the macro level.
So while we're on the anecdotal train, though, my wife and I flew Spirit to Vegas. I think it was Spirit. Like, here's the problem. I don't remember if it was Spirit or Frontier. I'm pretty sure it was Spirit.
Oh yeah,
Um,
similar.
we just we just paid for the upgrade to get like the big sort of their first class seats because it was like $100, but you get guaranteed overhead space and priority boarding and all that stuff. That was fine. It was an airplane. I was on it for an hour and a half. I wouldn't want to fly across country with them, but
Yeah.
for a slightly plussed up short jaunt, little jaunt to Vegas, it was fun.
Yeah,
Um,
here that for if you're going for a weekend and don't have to check any bags, I think it's
yeah,
probably fine because then you don't get, the added on fees. Flights themselves were fine, but yeah, going for a week from Vermont to Florida, I wouldn't recommend it.
no,
Vegas for weekends probably fine. Anyway, go ahead.
yes. Yeah, so the company filed for bankruptcy. They announced Friday after the close that they had reached an agreement with a super majority of their bondholders that would see 300 million in equity investments to whatever comes out of the other side of bankruptcy, and then 350 million in debtor in possession financing. And it seems to have been a pretty solid negotiated agreement for the company itself, but it's bad news for shareholders. Stock in Save, which now trades under the ticker SAVEQ. It's trading over the counter. Closed at $1.08 on Friday before the announcement came out. And then when it opened for trading the next week, this week, it was trading, 30 or 40 cents a share, and it's now trading around 15 cents a share. The big thing is if you are looking at Spirit, they have come out explicitly and said there's not going to be any recovery for equity holders when a company goes through bankruptcy, there's a very specific hierarchy on how you recover. At the top of the list is like secured lending. So if you have a loan to a company and it's secured by business or real estate, or I'm sorry, by real estate or property or airplanes, trucks, things like that, they recover first. Then is expenses like employment. So if they owe money to their employees. After that, you've got unsecured loans, and then at the bottom of the list is equity with preferred stock being the priority in recovery. And then if the company takes a loan during bankruptcy, it's called debtor in possession financing. Those guys immediately go ahead of everybody else on the list. So because of that, there's just not enough money to trickle down to the common shareholders to expect any kind of recovery. I was doing some research on this, and something like 2 to 7% is the recovery rate for equity investors. So if you're looking at Save stock, right, or Save Q stock, I guess now, um, you can buy it as a speculator, but it's very unlikely to pay anything off. You would basically need a competing bid from somebody else, some sort of deal that's better than anything that Spirit could negotiate. You need a white knight writing in, and you should not expect it. So this, I would say, don't buy Spirit in bankruptcy. There was a lot of speculation around Yellow, which was a trucking company, where some of their investors in bankruptcy did pretty well. Um, Stock rose from below $1 a share to like $6, $7, $8 in just a few months before they then cratered. But this is one that's an absolute stay away. So don't speculate on SaveQ. You're not getting any help coming.
Just the fact that it's Save Q now and not Save, it says a lot. I mean, Bruce Kaiser, my predecessor in who ran the Cabot Value Investor newsletter, used to specialize and do a really good job of finding companies that coming out of bankruptcy that did well. Still had some little juice left to squeeze, new CEO or debt restructuring, that kind of thing. But this seems like it's in the beyond repair category.
Yeah. Yeah. The shares that are outstanding will just get canceled. And once the company comes out of bankruptcy, they'll issue new shares.
Yeah.
So there is an outside shot that maybe something else could happen, but for all intents and purposes, if you're an equity investor in Save, whatever you're going to get selling the shares to people now, to speculators now, is about as good as it's going to get.
Yeah. Okay, real quick before we welcome on Nancy Zambell, people who want to sign up for Cabot Growth Investor, which is our flagship um, investment newsletter run by Mike Santolo, who's our chief investment strategist, been on the podcast many times. We're offering it right now at cabotwealth.com/street for 60% off the normal price, $197 just for the year, which seems like a really good deal for the quality of stocks that Mike has been finding for the last 20 plus years. Um, 30-day back, 100% money back guarantee if you want to just try it out for 30 days. But I think you probably would not want to ask for your money back because 197 for the year for the types of stocks that Mike typically brings in is well worth it. That's Cabot Growth Investor, and you can go right now to cabotwealth.com/street to get 60% off. Okay, let's welcome on Nancy Zambell.
1 second, Chris. First, just want to make sure everybody's aware that we do not have a podcast coming next Friday after that is going to be the Thanksgiving holiday. So I just want to get that out of the way while we are doing business.
Yep, I was mentioning that at the end, but yeah, good reminder. Okay, let's welcome on Nancy. Hey, welcome on Nancy Zambell, who is Chief Analyst of Cabot Money Club, Cabot Stock of the Month. And you're also, as we've had you on many times, you're a realtor and are tapped into what's going on in the housing market. So that's part of why we wanted to have you on today. Mortgage rates are still pretty high, despite the Fed's best efforts, maybe not best efforts. What are you seeing? I guess, like, why do you think that is? And what are you seeing in terms of, just anecdotally or locally, you're in Tennessee, what are you seeing in terms of, has appetite for housing increased at all? It's the same? Well, what's going on down there?
Well, first of all, thanks for having me. Nice to see you both again. Housing is just really weird right now.
Yeah.
None of the mortgage lenders I talk to have any idea why the rates are going up, other than they think that it's like the last hurrah to gouge people as much as they can
Right.
before the rates
Yeah.
start going down again. And most people are still expecting maybe a couple of points drop over 2025. But yeah, they spiked as soon as the Fed made that decision, to reduce rates. So that's kind of interesting. The higher rates, I think, have done their damage, probably all their damage they're going to do to the market. We haven't had anybody really complaining about it. We've got a lot of customers these days that are getting bridge loans because, they just haven't been able to sell their houses because inventory is up. I mean, inventory nationally is up. I just looked at those numbers. Hang on, I'll tell you what they are. It's like I had them right here. Hang on. Oh, up 0.7% to 1.37 million homes. That's a 4.2 month supply. That's on a national basis. So I don't know. People are just going, well, we want to move, so we're just going to do a bridge loan until we sell the other one. But we're locally, it's mixed. I mean, we're seeing some good activity up in the sort of resort type retirement areas, but those are usually pretty steady most of the time. Although talking to different brokers and owners, I get various answers. Some are really, really slow, haven't done anything. We've been pretty busy. So, it's a flip of the coin. Who knows?
Yeah, it's interesting that you brought up the retirement community side of it. I had seen a statistic that the average buyer is now, I think in the last quarter is now 56 versus in the prior quarter being somewhere in the 40s. So it seems like it's very segmented.
It is. It's really weird. Prices continue to go up, which I find that interesting considering how much inventory has gone up over the past year. But nationally, existing home sales, the median price is 407,200. New home sales now has spiked up above resales, and they're at 426,300. Locally, we're at 371,250, and ours are still going up 5 to 10% almost every single month over last year, which I think is weird. I don't know why that is happening, especially since rates are still pretty high. But for the next year, I mean, they're saying that it's still going to be a pretty good year, that they think that inventory is going to go up by 13%. I mean, it's gone up here by almost 40% over last year. And that's another weird thing. But we had inventory really, really low. Like one of the areas I serve is Fairfield Glade, which is a resort community. And normally they would have 300 to 350 houses listed at this time. After COVID, they were down to 12. I mean, there was just no inventory, and now there are about 75 to 100 houses listed. So that's really strange. So I don't know, but for next year, they're saying that sales should go up 5%. and that prices are still going to raise 2.3 to 4.4% of the estimates, and average over the last 40 years that houses go up 4.8% on average. I mean, people think, oh, I'm going to buy a house, I'm going to make a lot of money on it. Well, unless you're in the housing investment business, you can never count on that.
Right. Brad, you have something?
Yeah. So, mortgage rates now close to like 6.9%. I know you had written just, I don't know, a couple of months ago, back when mortgage rates were getting into the sixes, that, hey, you might want to take advantage and try and look at some refinancing now. I'm guessing you're probably not recommending that with the 7% rates, but what are you expecting going into next year? Is it still sort of a marry the property, date the rate environment, or is it more like, hey, buckle up? Where are you at?
Well, the lenders are still doing a lot of refinancing around here, which shocks the crap out of me too. But they're expecting, as I said, rates to go down 2% next year. And so, I mean, it's smarter to wait if you can to refinance. Although what will happen when rates start falling, all the lenders will start doing these specials. Where, oh, we'll refinance for no closing cost. Right now, they're still charging closing cost, and the rates for bridge loans too. I mean, all the fees and stuff are still pretty high. So, but that doesn't seem to be deterring people. I mean, and if you can wait and refinance and get no closing costs, then you're ahead. Because if you look at 5 to 6% closing costs on top of a refi, that's a lot of money, and it's not going to save you that much money on your monthly rate.
In terms of, just taking it back to sort of an investor's perspective, with, you mentioned you think rates might go down a couple points, mortgage rates might come down a couple points in 2025, along with, interest rates. How bullish are you on just, in terms of forward-looking investing for 2025? Where would you be looking if you're an investor and trying to invest in an improved housing market?
Well, it's funny because some of the experts in the arena are saying that the commercial market is coming back. And I think some of that is really due to the election, because one of the things that Trump and Musk have said is that everybody's got to go back to the office again. That you're going to be in the office 5 days a week. And of course, that really changed during COVID with the remote work. And the companies were trying to force people to go back to the office, and they wouldn't go. Now it sounds like maybe they're really going to be forced to go, or they're going to lose their job. So some people are actually looking at the commercial arena. But for a while, we weren't looking at any commercial stuff or like office REITs or any of that kind of stuff. But lately, some of the healthcare REITs have started picking up, especially in the biotech arena, that think there's going to be room for that. But on the actual real estate, residential real estate, I probably wouldn't be an investor at this point in time, because I think prices are still high. Rates were too high. It's not really a great market for flipping. I mean, I get a call at least once a week by somebody that wants to flip a house, but we don't really have any flippable houses anymore. The prices need to be considerably lower in order for that to work.
Yeah, I know Tom Hutchinson, who runs our Cabot Dividend Investor Advisory. I know he's been high on REITs, and especially as you describe, sort of more commercial REITs, where and not just commercial, but specific to sort of a niche. I think he had a biotech REIT. I can't remember what it was. Maybe still does. That place companies that need to use office space or things that they can't do out of a house, like labs.
Right.
Like, yeah, and things like that. It sounds like you mentioned healthcare REITs. Are there other REITs that you like going forward?
Well, the only other one that I like is that Sun Communities, which is manufactured homes communities. They also have RV communities now. It's SUI is the symbol. And that one looks pretty interesting. And then the two healthcare REITs that I'm looking at, they're both biotech related, developed properties for labs and that kind of thing, is Kilroy Realty, which is KRC, and Health Place Properties, which is DOC. And I think both of those are kind of interesting. and, still pretty well priced. I mean, the residential REITs are actually up 19% year to date, which I don't think most people realize till they start looking at them.
Not bad.
The only other REITs that have been up, the net lease were up 2%. Industrial and mortgage REITs were down. Of course, you'd expect mortgage REITs to be down with rates up high. The home builder stocks have been up 23.26%. And I still have three home builders that I think are kind of interesting. Green Brick, I think it's called GRBK, and they do business in Texas, Georgia, Florida, and they also do land purchasing. Pulte, which of course is one of the major national home builders, PHM, and then MHO, which is MI Homes, which was in your portfolio, Chris, and Value Investor, which we were in and out of and made a lot of money off of, but it's come down a little bit. They're primarily in the Midwest and the South, but I think they're also interesting to look at. So whether or not when I buy the REITs versus the home builders, I'd probably try to buy a little bit of the healthcare REITs and maybe one or two of the home builders.
Yeah, it's funny. The home builders, historically, when the Fed has started cutting rates, they're sort of the home builder stocks are sort of the first to get moving. And we saw a spike from a lot of them right after the first cut in September, and then they've sort of stagnated. I guess it's similar, the reason why mortgage rates have gone back up.
But
So
the
I feel
builders are
like
also starting to do a lot of incentives, and the banks and the lenders are starting to do incentives for the builders to keep them going.
yeah,
So I think it'll prop up the market.
yeah.
Yeah, I was happy to hear you bring up SUI. That's one that I know that you've written about in the past with some of the mobile home stocks, and I've seen come across, and that's one that makes a lot of sense to me, just given how persistently high some of the housing prices are. That looking for these alternate markets where, my in-laws have a property out on the East Coast that uses or that's got a manufactured home built on it, and you wouldn't know, right? Like it's not like manufactured homes 50 years ago. It's like, hey, no, this is like a stick-built property for as much as anybody can tell. So some of those alternate ideas are really sort of scratch that itch for me. I like that pitch.
Yeah, and they're becoming those manufactured communities down in Florida are a huge retirement draw because they're still much cheaper than buying a stick-built house, even though a Clayton manufactured home today can run you $250,000, which is hard to believe. But I have customers that bought one and put them on 25 acres that I sold them, and the outside it still kind of looked like a manufactured home, kind of flat roof, not much elevation, but inside they custom designed it inside. You can figure out where your walls, just like a house. I mean, you would never know looking inside that. And, of course, you've got the issue with the hurricanes, and we've had such an active hurricane season, and of course, those houses always get hit. But yeah, I mean, it's sort of that, and smaller homes are really the wave of the future, especially for the retirement set. I mean, I went personally from a 4,000 square foot home to a 1,400 square foot. And that, yeah, it's been a big adjustment, but you know what? I love it because I can close the door and go off, and I don't have to worry about maintaining a huge property or a seawall and all the crap that I don't know how many seawalls I built at my old lake house, but yeah, so I mean, I think the older people my age are getting into like what the younger people have done, where they like experiences more than having the big fancy house and the crystal and the china. And more people I know my age are getting the traveling bug. And we're just going to forget the big house. We just want to go do something, before we die.
Right. Moving on to the market. I know you mentioned we have an internal monthly editorial call among all our analysts. You mentioned that sentiment.
Bailey, enough. Sorry.
You mentioned that sentiment was pretty high.
Yeah.
Is that concerning to you, or?
Well, when the individual investors become very bullish, and hang on, Bailey, enough. She's barking at the cat next door. Sorry. Anyway, I think I've mentioned that, years ago, I was in New York City in a cab, and the cab driver's talking about flipping houses, and I knew it was time to get out of the market.
Right.
When they
Yeah.
start giving you investment advice, the same thing happens. And I think that one of the gauges was 60% on investors' intelligence the other day. 60% of the people were bullish. And yeah, that is concerning, although I mean, we're in kind of a long bull market now, but it's not the longest bull market that we've
No,
ever had by
no.
any stretch of the imagination. And I think that, I don't want to talk about politics, and I don't really care what anybody's politics are, but I think just this election, people are looking for change and they're excited about change, whether they're bad excited or good excited. And that is sparking interest. I think that keeps people alive and wanting to see what's going to happen. And I don't really see any reason for the bull market to end unless for some reason we went into a recession.
Yeah, it seems like we're fully in the wall of worry phase where there's still plenty of worries out there that isn't the over exuberance that we saw maybe during the meme stock craze of 2021. Or I mean, there are some signs. Bitcoin, you
Yeah.
just mentioned the individual investors sentiment, Bitcoin being at almost 100,000 now. There are signs, but like the equal weight index is only up 17% year to date. The small cap stocks have just gotten going. It doesn't feel like 2021 out there, I guess is
No,
what.
and every sector isn't blasting either. I mean, there are
Right.
still some sectors that could use a lot of they're well oversold. And so as long as that's happening, I'm not too worried. When everything gets to the point where everything's up, 20% and people are just starting to buy stocks no matter what and,
Right.
and without any rhyme or reason to them, sort of like back in 98 and 99 where you just bought anything that moved. Then I will start to worry.
Yeah.
Um, if the economy gets so strong that they start pumping rates up again, then I'll start worrying, but I don't think we're anywhere near that.
No.
So
Um,
what
and
sectors are you looking at these
my
days?
next question. Yeah, go.
Well, the financials I really, really like. I mean, they've come back somewhat. I'm still a fan of the technology. I think healthcare by and large is oversold, depending on where you're looking at. Some of these biotechs look pretty interesting, but those are very speculative. You can only put those in a certain portion of your portfolio. But and even the industrials, I mean, some of them have come up, but I still think that that's probably a decent sector for right now. Depending on what happens in Congress. I mean, if we get anything going back in Congress again, I don't think the renewable industries are probably going to suffer under this administration. Anything to do with EPA stuff. So I probably wouldn't look there, but I think the financials, especially the regional banks, which I happen to love, those will probably do well, especially if M&A increases, which is what people are saying, that, the M&A market has been pretty soft for the last year or two. And I think that's one area that we'll start seeing. It's funny with banks because as soon as they get gobbled up, more small community banks pop up again. Because usually it's the people that work at the banks, then they get merged into a big bank and they hate it, so they start their own bank and they put a lot of equity in it. And then 2 or 3 years down the road, the big banks come calling again, everybody gets rich. So I think that in technology, certainly in the AI industry, there's going to be a lot of M&A in that. It's going to be kind of like what happened with the tech boom way back when the internet really started. And the Apple suppliers, and now Google's got this big antitrust thing going on. There's going to be more people popping up in that area in the browsing and the search, and OpenAI is already talking about doing their own search engine. So I think there's going to be a lot of potential there.
Well, Nancy, thanks so much for joining us today. Always fascinating to hear about what's going on in your neck of the woods in terms of the housing market. It's fun to check in and see the temperature, especially as rates fluctuate. Hopefully, they'll be down from what they are now next time we have you on. But Brad, any last questions for Nancy before we let her go?
No, just thanks for coming on. Appreciate it.
Yeah.
Okay. You're welcome. Thank you. Happy Thanksgiving to you both.
Yeah. Happy
Yeah, happy
Thanksgiving again.
Thanksgiving.
Brad mentioned earlier, no episode next week, but hope everyone has a great Thanksgiving, and we'll talk to you again in a couple of weeks.